We're beginning a new reading on market efficiency, and before we dive right into market efficiency, perhaps no other theory in finance beyond the efficient market hypotheses, no other theory has courted so much controversy since it first appeared in the early 70s, and most people are divided between the market is efficient and the market is not efficient. You don't find too many people going, it mostly is, or maybe not. It divides people that when you think about it deeply, you can only either say it is efficient, you can come to the conclusion that it is, or you just reject efficiency altogether. Now, for those that reject efficiency, I want you, as we go through this reading, to question, are you rejecting market efficiency, or are you confusing wrong prices with inefficient markets? Prices can be wrong, can be arrived at efficiently, but still be wrong. So let's keep that in mind. So let's see what market efficiency is about. The extent to which market prices incorporate available information. And that's really just the heart of market efficiency, the extent to which market prices incorporate available information. And I'll say more about this information later. Market efficiency is the process by which the market incorporates new information. So efficiency deals with the process. Okay, let's just isolate that. Inefficiency is what justifies active management. Yes, the whole field of active management is based on, well, the markets are not efficient. Because we're going to see that a logical conclusion from efficient markets is that you cannot beat the market consistently. You cannot earn abnormal risk-adjusted returns, in which case active management is just a pile of crap. Now, at the end of this chapter, I have a playlist. Not a playlist, sorry. In the playlist, I'm going to insert a video, really professionally done. I like the way these guys do things. It's called "How to Win the Loser's Game," and the loser's game is active investing. It is actually called the loser's game. So I think that'll be a nice way to look at it. And in that video, you'll find Eugene Fama, the very founder of the efficient market hypotheses, talking about active management and how futile it really is. So I think that's really worth watching. So when we talk about market efficiency, we're really focusing on price efficiency, or what are called informative prices. And prices give us price signals. Now I'm referring more towards a sort of an Austrian economist view when I talk about price signals here. But price signals will determine where capital should be allocated to earn the highest risk-adjusted risk-adjusted return. And if we do not have price signals to rely on, or if price signals are distorted or inefficient, we get what's called malinvestment. So efficient markets avoid malinvestment. So the logical question is, well, what happens when a central bank steps in, manipulates the yield curve, and drives investors out of bonds into risk? Doesn't risk get mispriced? Isn't that an inefficient conclusion to a central bank intervention? Well, yes, you could argue that, but the movement out of risk, or the movement into risk, is an efficient response to what the Fed is doing. So, while it may create wrong prices in the sense that there are wrong price signals about what risk really costs, the process of moving into riskier assets when the Fed squeezes you out of safer assets is still an efficient process. Remember, it's the process that we're looking at. So again, let's stick with informative prices or price efficiency. When we have an efficient market, when we have prices that reflect the information, and we can avoid malinvestment, that promotes a healthy and sound economy and healthy and sound economic growth. Now, I'm going to make the distinction between the process and the information. All of this assumes, and it's a huge assumption, and this assumption, by the way, exists nowhere in the efficient market hypotheses. The efficient market hypothesis is the process by which the market incorporates new information into prices. Let's leave it at that. Here is where we get to the point where people confuse market efficiency with wrong prices. The efficient market hypothesis assumes that information is timely, complete, correct, and understandable. Correct and understandable. This is a huge assumption to make about information. It is a huge assumption to make that a lot of times we get information that is incomplete, may not be timely, may not be correct, and may be highly ununderstandable. Well, then how do you incorporate that information? And now the efficient market hypothesis says nothing about all of this. It says nothing about the nature of the information. It only talks about the process by which that information is incorporated into the prices. Let me give you a good example of correct and timely. And for anyone who's ever been in markets, you'll see it. You'll understand it right away. When economic data is released, and I'll draw out a timeline here, and let's say these are months. And let's just talk about the jobs report. Typically in the U.S., it's the first Monday of the new month we get the jobs report, which is a big deal in the U.S. It moves markets. Well, the next month when we get the jobs report, if you watch closely, there'll be revisions to the month before, which means when this information came out, it wasn't complete and it wasn't correct. But it will be incorporated into prices. So if you have a belief that the information arriving is not correct, that information is not right, it's not correct, it will be incorporated into prices efficiently, but will lead to wrong prices. So that's we have to look at all information that lands in the market and ask ourselves, does everyone understand it the same way? Does everyone use it the same way? One piece of information can be seen by two completely different groups of powerful investors as bullish and bearish at the same time. How do you understand the information? Now, that'll get incorporated into prices, but it's not clear what every piece of data means. It's not clear that every piece of information is correct, complete, or timely. So, moving from information to price, this arrow, that's where efficiency lies. It says nothing about this. All right, just to be clear. So, when we go through this, the different forms of market efficiency, I want you to ask yourself, do you believe that markets are inefficient because you think prices are wrong? if you think prices are wrong, you might want to blame the type of information finding its way into the market and not the mechanism by which this finds its way into the price. It's hard to argue that markets are inefficient in putting information into price. But I think it's much easier to argue that that information doesn't mean the same thing to everybody, may not necessarily be correct when it first arrives, may not be complete, and may not be timely. That leads to a whole bunch of wrong prices, but an efficient mechanism by which that wrong information enters the price. I hope I've taken some pains to frame this argument, but market efficiency gets caught up with the idea of, well, the prices are right. That's not what it means. It means the process by which that information gets put into the price is an efficient process. So, asset prices will reflect new information quickly and rationally. That's market efficiency. In a nutshell, asset prices will reflect new information. We're making no qualitative opinion about the nature of this information. We're just saying, is it new? There you go. We'll incorporate or reflect new information quickly and rationally. What is quickly? Depending on the market. Currency markets, that happens fast. Equity markets, there's probably a lag. Anywhere from a minute to an hour is what we typically mean by quickly. Now, we'll see later on that, well, there's persistence beyond the hour, and we'll talk about what causes that persistence, that serial correlation in returns. But let's just keep this right now. Asset prices reflect new information quickly and rationally. That's market efficiency. When we say new information, what we're saying is the unanticipated element. So you may have an economic release. Here's the week, Monday, Tuesday, Wednesday, Thursday, Friday. You may have an economic release Friday, but on Monday, we know what the consensus is. The consensus opinion on Monday will have some opinion. The market will begin to price in the consensus opinion. If on Friday the data is equal to the consensus opinion, there is no new information to price in. However, if on Friday the data released is not the same as the consensus, we have an unanticipated element. It is that unanticipated element that will be quickly and rationally priced in. So that, in conclusion, prices incorporate all past and present information. Well, if prices incorporate all past and present information, you can start to see of the different forms of analysis we can do on the market, and I've been critical of this before, that technical analysis seems to be rather useless. We'll see what efficient market hypothesis has to say about that. Here's a conclusion. Consistent, superior, risk-adjusted returns are not achievable in an efficient market. What they're saying here is that a return from passive investing will always beat the return from active investing, simply because with passive, you don't got to pay the fees. You don't got to pay all those costs. You have a portfolio that tracks the market and that's it. Active, you've got churn, you've got turnover, you've got management fees, platform fees, access fees, research fees, information fees. All of those fees eat into the return. That's a huge statement to make. That's a huge indictment of the whole side of the industry of active management. So we'll see what we have to say, or what the theory has to say about that. And again, I want you to watch that video at the end of this chapter called "How to Win the Loser's Game," because they present some very good data on active management and have some very high-profile names sounding in on it. And the consensus is of one kind only: active management sucks. Well, it doesn't suck for the portfolio manager. It works for them. It works for the finance industry if you're inside the industry. It does not work for the clients of the finance industry. Okay, I'm going to try something new here. I haven't done this yet. But you'll notice on the screen now I'm not really writing anymore, but I've got some typing out here. And what I'm going to do is I'm going to incorporate some of the questions that we find in the readings into the videos, just so that we can talk through them to see what's going on. And I know that you can read them and read the solutions yourself, but sometimes a different perspective helps on how we read it and how we break it down. So here I go. And by the way, if you like the typing on the black screen better than my writing on the black screen, leave a note in the comments section saying, yes, I like it, or no, go ahead and keep writing. Anyways, here we go. Suppose that a speculative grade bond issuer announces just before bond markets open that it will default on an upcoming interest payment. In the announcement, the issuer confirms various reports made in the financial media in the period leading up to the announcement. So, the announcement appears to be confirming what the market already knew. Prior to the issuer's announcement, the financial news media reported the following. Suppliers of the company were making deliveries only for cash payment, reducing the company's liquidity. The issuer's financial condition had probably deteriorated to the point that it lacked the cash to meet an upcoming interest payment. So the combination of 1 and 2 appears that the market was already concerned that, you know what, chances are they're going to default. Chances are they're going to default. Number 3, although public capital markets were closed to the company, it was negotiating with a bank for a private loan that would permit it to meet its interest obligations and continue operations for at least 9 months. There's the hope. And it is a truism in all of life, and I'll write this out, a truism, hope dies last. Hope dies last. So, if the issuer defaults on the bond, the consensus opinion of analysts is that bondholders will recover 36 to 38 cents per dollar of value. So, we haven't looked at what the questions are. We've just laid out the scenario here. So, the statement that they made is that they will default on an upcoming interest payment. Number 1, number 2 sort of suggested that. Number 3, there was some hope there. This announcement kills that hope. All right, so let's look at the type of questions that we would want to answer on this. So question number 1, and this is a type of question you might see on a CFA exam. If the market for the bond is highly efficient, actually, let me backtrack. This is not a type of question you would see on a CFA exam simply because that whole preamble, that long paragraph we read before we got to 1 or 2, you would not see that in a level 1 exam. A level 1 exam would have a standalone question. When you get to level 2 and level 3 where you have scenarios and then a bunch of questions related to that scenario, yes. But sorry, this is not a type of question you would see on a level 1 because you would not be expected to have that full preamble. A level 1 question would start something like this and end here. It would be a standalone question. So let's keep going. If the market for the bond is highly efficient, the bond's market price is most likely, watch these words in the questions, it doesn't say is, it's saying most likely, which means A, B, or C, you might read A, B, and C and go, yeah, they all will. Most likely, watch for those words, least likely, most likely, etc. The bond's market price is most likely to fully reflect the bond's value after default. If the market for the bond is highly efficient, the bond's market price is most likely to reflect the bond's value after default. A, in the period leading up to the announcement. Well, what did we know in the period leading up to the announcement? We knew that the company had to pay cash for deliveries, and it was probably their financial condition probably deteriorated, and they weren't going to make that payment, but hope was still alive. So no, because in the period leading up to the announcement, hope would still be priced in. In the first trade prices after the market opens on the announcement day, or when the issuer actually misses the payment on the interest payment date. An efficient market will price in new information, in other words, the unanticipated element. What's the unanticipated element we have here? The announcement said they are going to default, which means hope dies, so it's going to be priced in shortly after that announcement. The announcement was made just before the market opened. There's your answer right there. In the first trade prices after the market opens. If the market for the bond is highly efficient, the piece of information that bond investors most likely, again, watch these words, most likely focused on in the issuer's announcement was that the issuer had failed in its negotiations for a bank loan, lacked the cash to meet the upcoming interest payment. You know what? We already knew that. So no. Had been required to make cash payments for supplier deliveries. We already knew that. This is the only new information. So it would be A. That they would most likely focus on in the announcement was that they failed in their negotiations with the bank loan. Learning objective B, LOSB. Keyword here, distinguish. Distinguish between market value and intrinsic value. This will be quick work. Market value, MV. the price at which an asset can be bought or sold, the bid or the ask. Remember when we talked about bid or ask before, we never say what's the price of an asset, we say where's the market. The market's at the bid to the ask, so that is the market value. That's if you want to buy or sell that asset, that's what you got to do it at, market value. Intrinsic value, on the other hand, IV, also sometimes known as fundamental value, the price of an asset, if complete, there's that word complete, right? Complete, timely, accurate, and understandable. Complete information and understanding were used. Typically, we arrive at an intrinsic value through the present value of future cash flows because, how else are you going to do it? That's what we get, right? I say typically, not always, typically. Here's the problem. Intrinsic value requires judgment. It requires a valuation model. Well, maybe your model is wrong. If you're coming up with an intrinsic value that doesn't equal the market value, could the market value be wrong, or could your valuation model be wrong? So it requires judgment, and intrinsic value in the end is really just an estimate. So you may, after your lengthy analysis of a particular asset, come up with one of three conclusions: that intrinsic value is less than the market value, which means it's overvalued. The market, you'd have to pay more in the market than what you think it's worth. It's overvalued. You'd be issuing a sell or an underweight rating on it. Sell if you already own it. Underweight if you have to own it, but you have a choice in what weights that you can assign to it. Active management can underweight certain components of an index. We've already talked about index and weighting, so you get that, right? If the intrinsic value is somewhat near the market value, somewhat near, and most analysts would say if you're 10% above or 10% below, some go even wider and say up to 20% above or 20% below. I think these are wide angles. I think a 20% margin, 10% up and 10% down. If your intrinsic value falls within this range of the market value, you would conclude that we're looking at something that's fairly valued, so you'd issue a hold rating or an equal weighting. And if our intrinsic value is greater than our market value, that means the market is underpricing it right now, it's an undervalued security, there's a buy rating or an overweight rating. So, like I said, I'm trying out something new here, and we're going to just run through a few questions. An analyst estimates that a security estimates that a security's intrinsic value is lower than its market value. The intrinsic value is lower than market value. What does that mean? Overvalued. The security appears to be, we've already found it, overvalued. A market in which an asset's market values are, on average, equal to or nearly equal to intrinsic value is, notice these words here, best described as a market that is attractive for active, passive, or both active and passive investments. Now, you might say, well, active, you can make an argument for all three, but is best described, you got to watch this, is best described. If a market in which an asset's market values are equal or nearly equal to intrinsic value, that means there are no returns to be gained from active management, you'd say passive. Best described. You can make the argument about all three, but it's going to be that. That's really what this reading is leaning towards, is to make a distinction between the benefits of active investing over passive investing in an efficient market. And the conclusion that we're going to get to is it really isn't there. Suppose that the future cash flows of an asset are accurately estimated. Now, it's just a question. It is just a question, so sometimes we have to take things the way it's written without questioning. We are asked to suppose that they are accurately estimated. How can the future be accurately estimated when it's unknown? That to me, I'd stop right there and say it's a terrible question to ask. There's a fundamental flaw in the question, is that you cannot make that assumption 100%, but for the sake of the question. Okay, the cash flows are accurately estimated. I'll give you that. The asset trades in a market that you believe is highly efficient based on most evidence. So it's asking us to assume two things. You got accurate estimates, you got a highly efficient market. but your intrinsic value estimate exceeds market value by a moderate amount. So more than 10%. The most likely conclusion is that you have overestimated the asset's risk, underestimated the asset's risk, or identified a market inefficiency. Well, it's asking us to conclude two things. Our forecasts of cash flows are estimated accurately, and we have a highly efficient market. So we can eliminate the third one. We have not identified a market inefficiency because we're being asked to disavow one of the assumptions in the question. You can't do that in these questions. When a question gives you two assumptions that they want you to make, assume this and assume that, you cannot choose an answer that negates one of those assumptions. So let's just take that right up. So we have to understand how risk plays into this. Remember now, when we value something, it is the present value of cash flows. Well, what are cash flows? Well, how do we get that? Well, we discount it by 1 plus R. What's R? R is our discount factor. It's a measure of risk. So if we're too high, we must be discounting it by a sum that is too low. Exactly, too low. So we have underestimated the asset's risk. We are on our next learning objective, LOSC. LOSC asks us, our keyword here, explain. Explain factors that affect a market's efficiency. So logical question, if we talk about market efficiency, are all markets efficient? No, not all markets are efficient. So if they're not all efficient, what is impeding that efficiency? Well, let's look at two ends of the spectrum, inefficient versus efficient. We'll look at some factors. Market participants. Now this is a big one, market participants. We have more efficient markets if we have more and numerous market participants. And we have an inefficient market if we have fewer or few market participants. So even within a developed country, let's take the US or Canada or Germany or France, even within all of these well-developed markets, we can say that we have very efficient public markets, but we have very inefficient private markets. That's why things like venture capital or private equity tend to earn higher returns simply because they are inefficient markets. There is more room in there if you are superior at what you're doing, superior analysis. What about information availability? The wider the available information, the more efficient the market, the narrower, the more inefficient. So if we're looking for places where we can have very inefficient markets, the private markets, and that's the market for private equity, or even private debt placements, tends to do a lot better. Financial disclosure. Efficient markets have more disclosure and more standardized disclosure. We did a whole reading on accounting standards, IFRS and US GAAP. Versus inefficient markets, which has less disclosure and variable reporting standards, where companies report based on how they feel. They don't have to follow the standards because it's not for public consumption, it's private. The limits to trading, whenever limits are set upon trading. Efficient markets have speedy transactions, transparency, and no restrictions on trading, such as short selling. Now, in some markets, you cannot short sell, and even the U.S. did this. At the height of the financial crisis, it identified something like 40 or 50 financial stocks that overnight on a Thursday night, they came out the day before options expiration. Oh, that was planned, by the way. Paulson came out and said, okay, these stocks, you can't short them anymore. You had options expiration the next day. What happened the next day? All of those stocks popped. Goldman Sachs popped by almost $25. Anybody holding options at that point had 1 day to expiration. They were in the money, dead in the water. I think they did that on purpose, by the way. Anybody who was trading at the time and who got caught on the wrong side like me remembers that with bitterness. Anyways, inefficient markets, slow or lagged transactions, illiquid markets. Well, this is almost all real estate and almost all private investments. Lack of transparency. And restrictions, if there are any restrictions. So once you introduce short selling, even into public markets, you introduce no more short selling. I shouldn't say even into public markets. You can't short anything in a private market. But once I've been using just the example of private markets down here, but Any restrictions like short selling on public markets will create inefficiencies because you lose that side of the information. Transaction costs versus information acquisition costs. Transaction costs, mispricings, would still be considered efficient. Even if we found mispricing in a market, it would still be considered efficient if it is within the bounds of arbitrage. So we can find a mispricing situation where buy one asset, sell another asset to get the prices to converge, but after you consider transaction costs, it's not worth it. That's what we mean by the mispricing is within the bounds of arbitrage. Information acquisition costs. The classic view was if we take return equals the risk assumed, that the return you realize on any asset will equal the risk assumed in an efficient market. Therefore, information costs equal a waste of time. Because where would you take it from? Your return, you'd have to subtract your information costs from your return. You'd always be lower than the risk assumed. You'd always get a lower return. The more modern view says, well, hang on a second. It is the very information that's accumulated and digested that actually leads to this efficiency. So you can't just discount that. So the more modern view is if we take our return minus our information costs, we will get a return that is equal to the risk assumed in an efficient market. So in an efficient market, it is saying there is a return to information, to information search and information costs. There is a return to that, and our net return will be the risk assumed. That's the more modern view, because you can't throw out the idea of information search. You can't throw that out, because if you did, you would end up with inefficient markets. It's the very information that is being priced into the market, but that information doesn't come around freely. There's a cost to getting it, and even if it shows up freely, there's a cost to determining what it's worth. You have to have an analyst sitting there looking at that information saying, I think it means this, I think it means that. Well, they're not sitting there for free, right? There's still a cost for a brain to take even free information and turn it into knowledge. We're on our next learning objective, LOSD. LOSD has a keyword contrast. Contrast weak form, semi-strong form, and strong form market efficiency. And rather than go through it and then provide the table, let's look at the table up front so we can see exactly what's going on. Forms of market efficiency, weak, semi-strong, and strong. Past market data, public information, and private. So weak form information incorporates all past market data. Semi-strong form incorporates all past plus all public, and the strong form goes even further and says even private information is in there. And if you want to go back to some of the source documents, Fama, 1970, this is where he first presented this taxonomy. So what we can see is that if we have a semi-strong market, well, by default, we've also got a weak form market. And if we have a strong form market, by default, we have the other two. So you have to keep in mind that there is a hierarchy. We cannot just have semi-strong market efficiency, but weak form inefficiency. It is if we get to semi-strong efficiency, we are by just inclusion of past market data, we are weak form efficient as well. So we'll step through each of the forms with its own screen. Weak form, future returns should be independent of past returns or patterns. Well, that's the whole basis of technical analysis, that future returns are not independent. Future returns should be independent. No serial correlations, no trading rules. Proponents of weak form efficient market hypotheses assert that abnormal risk-adjusted returns cannot, let's underline that word, cannot be earned by using trading rules and technical analysis. So the weak form specifically shoots down technical analysis. Now notice, we're going in a hierarchy from weak to semi-strong to strong. Technical analysis is defeated at the first level. Weak is defeated right there. So, cannot be earned by using trading rules and technical analysis, which make investing decisions based on historical market data. So, the only thing we have to end up with is, are markets at least weak form efficient? If they are, we can discount technical analysis, which, if you've been with me through the quantitative analysis section, I think you know my opinion about technical analysts. I think we can put them in the same boat as all those fraudulent professions out there, like psychics and chiropractors, right? Our semi-strong form, as I said before, encompasses the weak form, so we don't have to revisit that. So whatever we can say for the weak form, automatically implied in the semi-strong form. Considerable research support in developed markets for semi-strong form of market efficiency. There is considerable support in developed markets that they are in fact semi-strong. So if they're semi-strong, they are at least weak form strong, which means technical analysis is garbage. Proponents of the hypotheses assert that investors cannot earn abnormal risk-adjusted returns if their investment decisions are based on important material information after it has been made public. That is a key term here, after it has been made public. Let's just read that again so we understand that. Cannot earn abnormal risk-adjusted returns if their investment decisions are based on important material information after it has been made public. In other words, your analysis has to anticipate this information, not wait for it to happen. You have to already know or already have a very good belief of where things are going. You can have superior information processing skills, but you cannot wait until after it has been made public and hope to do better than the market. They stress that security prices rapidly adjust to reflect all public information, but notice now it does not make any specific judgment on that information. It could be right information or wrong information. If it shows up, it's just information. It's inert. It doesn't have any kind of judgment associated with it. So, semi-strong, again, says nothing about the information itself, only whether it's new or unanticipated. And finally, we have our strong form hypothesis or strong form market efficiency, which will encompass both weak and semi-strong forms. And we've found that we have there's lots of evidence to suggest that this is true, which means there's lots of evidence to suggest this is true. But research rejects the strong form hypotheses. And I'm actually saying that slightly wrong. This is just the way people understand it. So you say research rejects the strong form hypotheses. If we were saying it in the true method of hypotheses testing, we would say research fails to accept the strong form hypothesis. Remember, you have your H0 and your HA. The HA is the interesting one. And here in this case, the interesting hypothesis would be strong form. So research fails to accept the alternative. It fails not to reject. It just rejects the strong form as the language of the street, but the language of hypotheses testing would say research fails to reject the null. In other words, it fails to accept the alternative. Strong form EMH assumes perfect markets where information is cost-free and available to all. Under strong form EMH, no one can consistently achieve abnormal risk-adjusted returns, not even company insiders. And I don't think it takes much to say, well, that can't be right. That can't. If I have inside information, I got private information. I got private information that nobody knows. There must be something I can do with that private information. And turns out, yes, there's no support for a strong form EMH. Moving on to our next learning objective. Our keyword here is to explain. LOSE, we're on now. Explain the implications of each form of market efficiency for fundamental analysis, technical analysis, and the choice between active and passive portfolio management. And I think you pretty much know where this is going to end up. Conclusions that we got to. Number one, security markets are weak form efficient. We know that. Security markets are semi-strong efficient. There's point number 2. 1 and 2. They're semi-strong efficient. So the implication of number 1 is that technical analysis will not produce consistent abnormal risk-adjusted returns. So we can eliminate technical analysis at the very first hurdle, weak form. Jumping the next hurdle, yes, we find support for semi-strong efficiency, which means analysts must consider what is already priced in and how new information will affect prices. So it's the unanticipated aspect of the information that analysts have to figure. Well, if the consensus, if the actual number comes in above consensus, what do I think will happen? If it comes in below consensus, what do I think will happen? So the combination of 1 and 2, The implication for portfolio management: active managers are actually a waste of money for investors. And again, I want you to watch that video at the end of the loser's game. And the third conclusion we got to is security markets are not strong form efficient. One of the reasons why they're not, and I think we can easily say that, is insider trading is illegal. Big stick if you get caught, and the stick being prison. Well, at least we hope that it would be that the criminal justice system is as efficient as markets are and puts the insiders into prison, right? We are on our next learning objective, LOSF. Keyword here is to describe, and it's very short. Describe market anomalies. Now, let me start off with a little bit of a warning here on these market anomalies. I don't believe any of them. I've been through the literature when I was doing my PhD. I spent a lot of time in the finance literature. I've been through all of these anomalies, and you'll tend to find one or two papers that find them and another 15 papers that cannot replicate it. And again, you go to another one of the effects, you find one or two papers that find the effect in a data set in this particular market, in this country, and you'll find another 10 or 15 that simply cannot find it. So can you find one of these anomalies in a data set somewhere? Yeah. Can you consistently, the idea behind having something is that you can find it not only in the market and the time period you selected, but across markets and across time periods, not just in the 60s or the 70s or the 80s or just the 90s, but across all the decades and across 5 or 6 markets. Now you got something. Now I'll listen. But when you find it once somewhere, that to me sounds like a statistical artifact of the data set you had when it cannot be replicated and when it doesn't have a sound reason why. When you have to dig around and hypothesize after you find it, saying maybe it's this and maybe it's that. Well, again, that's data snooping, that's data mining, finding a relationship and then hypothesizing what it is. So, I don't know how seriously you want to take this section, and I don't know how seriously the CFA is going to test you on this. If you get a question on this stuff, I'd be surprised. I think that it's just something there to say, look, be aware that you're going to run across people who talk about these anomalies. Okay, so let's go. Time series anomalies. We have calendar anomalies, a January effect, a turn of the month effect, a day of the week effect, a holiday effect. You know, when you start including all of these effects in, it's almost every day of the week. It seems. I eliminated, by the way, the weekend effect. Oh yes, there's one of those too. The January effect, higher returns in equity markets compared to other months in January. By the way, doesn't exist anymore. Turn of the month effect, higher returns on the last trading day and the first 3 days of the next month. The day of the week effect, average Monday returns less than 0. The average is less than 0 and lower than the other 4 days. And a holiday effect. The day prior to holiday tends to have higher returns. Again, all lack persistence, which means they've all been found, but they've failed to be replicated at different time periods and in different markets. They all lack persistence. And when they lack persistence, well, then that's not an anomaly. That is a curiosity of the data set you got and nothing more. Still on time series anomalies, overreaction anomalies, and then we'll look at momentum anomalies. An overreaction anomaly, investors overreact to the release of unexpected new information. Good news inflates prices, bad news depresses prices. So this kind of suggests that, you know what, if there is an overreaction anomaly, the use of a contrarian strategy might work here. But here's the deal. What is the nature of the good news and what is the nature of the bad news? You can't just look for excessive price movements and say, aha, I've got it. You got to look at why. And sometimes, yes, I will agree, sometimes bad news comes out and something sells off dramatically, far in excess of what the bad news really was. And sometimes good news comes out and something goes up dramatically for 3-4 days in a row, way beyond really what the good news was. But there is no persistence in the sense that stocks will overreact only to the downside or only to the upside. When stocks overreact, they tend to overreact equally to the downside and equally to the upside. That's part of efficiency, is that there is no pattern to the overreaction. Maybe there is an overreaction, but at any given time, you don't know if the overreaction is going to be to the upside or to the downside persistently. So, momentum anomalies. Securities that have outperformed in the short run continue to outperform. Now, I have seen this, and I have seen this especially if, for some of you out here, you might recognize this. There is a daily paper out there called Investors Business Daily, IBD. And on Friday at 6 p.m., you get the top 100 list. And this is a momentum list. And usually the number one stock listed up there usually sees momentum, serial correlations, as long as it stays at the top of the list. I can't tell you how many times that number one stock is being pushed to absolutely stupid levels that everyone agrees is stupid, but it's a momentum game. What they call the MOMO crowd, the momentum crowd. And when they're done with one of these, they're done with one of these. It breaks, and it breaks hard. And it's really just a game. But I don't know so much that it's an anomaly as a group of people that implicitly agree that let's just keep driving the price of this up until other people take it, and then we'll ditch it on them. I don't know if there's a regulator out there. They might want to look into this, because IBD has a habit for their number one stock of trying to pick stocks with very small floats, like 4 or 5 million shares, that suddenly drive way up in price. I got a suspicious mind, and when I see something like that, I think front running. That's just me. Anyways, if you want to see what a momentum effect looks like, have a look at IBD, have a look at their top 100 list, and watch what happens to the number one stock. That's a good example of momentum. Another good example, before we go, another way to find momentum, and this is actually a kind of a neat way, I kind of like this one too, is to look at the 52-week highs, 52-week highs and lows. And what you'll notice is, if you're tracking the 52-week highs, if you see a stock hit the 52-week highs, several times within a 1-week period, I have found that if you buy all of the ones that do that, they tend to continue to go up. And if you do the same with the 52-week lows, they tend to do the same thing as well. Now, I don't know how persistent that is. That's a strategy I used when I was first starting out, is how do you find ideas? And I hit upon the 52-week high and low list, and unbeknownst to me, I simply just found a momentum strategy without being told that that's what it was. I was momentum trading without even knowing I was momentum trading. But I know that it worked, so this momentum anomaly, you know what? I'll give it. I'll give a tip of the hat to that one, because I do see it. Not always, but I do see it. Okay, moving away from time series anomalies, let's look at some cross-section anomalies. We have a size and a value effect. The size effect. Small cap equities tend to outperform large cap equities on a risk-adjusted basis. Again, not confirmed over time. So maybe it might have been found in a few places, but over time it has not been found. A value effect. Value stocks outperform growth stocks over time. But if you use a three-factor model, and this is the FAMA French model, FAMAFRENCH, a three-factor model for valuation versus the CAPM, which is a one-factor model, the three-factor model eliminates this anomaly. And what's a three-factor model? Market returns, which is what's in the one-factor model, the market value of the equity, and the ratio of the book value of the equity to the market value of the equity. So if you value stocks on three factors, you eliminate the value effect. So as we get more sophisticated in how we can model data, we find that some of these anomalies disappear, which means they never really existed. It was just an artifact of the statistical methods used at that period in time. And some other anomalies that neither classify as time series or cross-sectional. Closed-end fund discounts. And yes, closed-end funds typically trade at a discount to their net asset value per share. But it's typically not worth the transaction costs to buy up all the shares of the fund in the open market and then sell off all of the components in the fund and earn the difference. It doesn't, the transaction cost would never allow that. So even though they trade to the discount to the net asset value per share, that's because of the strategies they can use. It's because of the strategies they can use, which are different than what a mutual fund could use. So as we get more into what closed-end funds can do, in your journey over these 3 years, you will visit this a little bit more. You'll see that it's the uncertainty in the strategies that they can use that typically lead to their discount to net asset value per share. B, earnings surprises. May be slow to adjust. A company that has an earnings surprise either to the upside or to the downside, the price may be slow to adjust, and I'll agree with that it may be slow to adjust because not everybody gets the information all at the same time, and even if they get the information all at the same time, I've been in this situation before where I'll see the earnings report before the market opens, and my reaction is, I want to see how the market responds. If I see good price action, if I see that the market is willing to buy on this, then okay, I feel fairly good that I'm willing to add a little bit more to my position. But I want to see how the market responds first, so I may take a couple of days just to see how the market responds. So it's not a matter of I don't know what I want to do on day one. It's I want to see what everyone else does first, and sometimes that's a rational thing to do. IPOs, if you can get shares at the offer price, then there is some possibility of abnormal returns. At least that's what the anomaly is. And the predictability of returns based on prior information. And this is really economic cycle related, that when interest rates are at this level, these stocks tend to outperform, and when economic data is like this, or with this part of the business cycle, you want to be in these sectors, they tend to outperform versus these other sectors outperform on a risk-adjusted basis, that is. All of them, look on the side, not supported by consistent and persistent evidence. None of them are. Now, one can make the argument, and it's a valid argument, that let's say you do find a true anomaly, that you find something anomalous. Well, the moment you publish that, if it's true, it will no longer be true because everyone will act upon that anomaly, thereby eliminating that anomaly. So, perhaps there were true anomalies in these things, but you got a lot of finance academics out there, and the currency of academics is publications. So you got a lot of finance professionals data mining, trying to put out papers saying I found this and I found that, and maybe they did, but the moment they publish it, because they're not interested in trading on it, that's not their currency, they got to publish that stuff. The moment they publish that, then it'll disappear. So you could say that the information production system is efficient in the sense that if there is an anomaly, you have so many PhDs that need to publish, you have all these eyeballs looking at all this data, what do you think you're going to find? You're up against all these PhDs that gotta publish. What do you think you're going to find? You're not going to find any tricks. Stop looking for them. That's not the name of the game, trying to find this little trick or trying to find the philosopher's stone that turns lead into gold. That's not going to happen. You're going to be great by being better at processing information, not better at finding these little tricks. Oh, I'm going to buy on Monday, sell on Friday, or buy on Friday, sell on Monday, whatever. You're not going to do it. Get that out of your head. And quit drawing lines on charts. That's idiotic. You're going to be great at this by being better at processing information. That's what it comes down to, is having a deeper understanding of what the information means, when to trust it, when to distrust it. And to know that the difference between private knowledge, public knowledge, and common knowledge. And when we get to level 3 on behavioral finance, you'll get more into that idea of common knowledge, that you don't trade on common knowledge, and that there's nothing valuable in public knowledge. It's private knowledge that you have to look for that is not insider information. That's brutally hard to do. We are on our last learning objective for this reading. Describe behavioral finance and its potential relevance to understanding market anomalies. And you're not going to get a good introduction to behavioral finance in this reading. You're going to get just a little taste of it. There is a larger amount of behavioral finance you'll have to get through at level 3. Much larger, much more significant, because it has gained a lot of significance simply because it does put a lot of economic assumptions about investors into question based on actual behavior. So, what is this behavioral finance thing? It examines investor behavior, observed behavior, rather than relying on normative assumptions such as rationality. In fact, we pretty much know now that we are not rational decision makers. And by rational, that doesn't mean optimal. I've said this before in the economic series, but if you haven't gotten there yet, I'll take a moment and say this. Rational does not mean that you make the best decisions or the most optimal decisions. It means you make consistent decisions. It means if you prefer A to B and you prefer B to C, you should prefer A to C. To suddenly prefer C to A would be irrational because it's not consistent with the transitivity of your preferences. That's all rationality is. But we're not rational. We're not consistent. We make different decisions when we have gains, and we make far different decisions when we have losses. So, investors do not always make efficient, by efficient we mean rational and optimal here, efficient decisions. And that is due to cognitive or behavioral biases. And we also should throw in there emotional biases. Emotional biases. Here's a lesson that you should all remember for the rest of your life. Never go to buy a vehicle when you're in a good mood. Never do it. When you're in a rotten, pissy mood, now's the time to go shopping for a vehicle because you are not going to like that price. Period. You don't want to be in a good mood. Because when you're in a good mood, you let things go. That's all right. That's good. You have lots of good. Be in a rotten mood. Stay up for 2 days straight, then go shopping for a vehicle. Let me tell you, you're going to get the best price. Okay, let's look at some of these biases. Number one, loss aversion. Loss aversion. The tendency to prefer avoiding losses to acquiring gains. And some people think this way. Some people look at situations and they think, what's my downside? Where could things go wrong? What can I lose? Other people look at situations and want to know, what's my upside? How much can I make? But in general, most people have a tendency to prefer avoiding losses as opposed to acquiring gains, because losses are twice as powerful psychologically. We don't feel as good about making 100 as we feel as bad about losing 100. That's what that's saying. Here's the interesting thing about loss aversion now. It can actually lead to something called loss persistence. The unwillingness to actually take a loss. So we could buy a security that starts dropping in value and argue that I'm just going to hold on to it. I'm not taking the loss because we don't want to take the loss, and we feel that if we don't sell it, if we don't close our position, we haven't really taken the loss. So that leads to loss persistence. Not only does it lead to loss persistence, but it leads to a whole bunch of other things. One of them is called the Concord effect. Which means putting more money into something even though there's no evidence it's going to work. What do people do when they buy stock and it starts to drop? A lot of them, they're willing to gamble. I'll buy more. I'll buy more. I'll double down on this one. And because they're unwilling to take the loss. That's called loss aversion. Next one is herding. Investors ignore their own analysis and make decisions in line with the direction of the market. Now this one, I'll kind of say, you know what, and I put it in white here, that can often be a rational thing to do. That can be a rational thing to do. If the market, if the support in the market is broad-based and wide and it's going up, but your analysis says, no, this is an overvalued market, it's overheated, why am I the only one? You may not be the only one. It's just you look at the market and you say, I think I'm the only one. I'm certainly not going to stand in front of the crowd. You're not going to do that, especially going short. But there may be somebody else out there thinking the same thing that you're thinking, but they're looking at the market going, I'm not shorting this. In fact, you could end up with a situation where everyone agrees that the market is overvalued. Everyone agrees. But nobody thinks that anybody else thinks it's overvalued. So everyone believes they've got private information when in fact it's common knowledge. When in fact it's public information. What you need to get to a point of common knowledge where I know it's overvalued and you know it's overvalued, but I know that you know it's overvalued, and you know that I know. That's common knowledge. Now we have there you go. Now you want to. Now you can work on your on whatever belief you have. But if the market is going in one direction, broad-based and strong, who cares what you think, right? You have to think, maybe I'm wrong. Think about it this way. If you're in a crowded theater and someone yells fire, and there is a fire and everyone's rushing for the door, that's an irrational thing to do. You should walk. More people will get killed that way. However, it is not rational for you to sit there and wait for everyone to leave. It's just as rational for you to follow the crowd and be irrational and rush for the door because everyone else is. It's your best strategy. So for herding, there are times where I think it's probably wise to run with the herd. This ends up with something called correlated strategies, where you take a bunch of funds, suddenly they're all doing the same thing. That's a correlated strategy. Now, when that strategy is over, you got a bunch of funds that are going to leave that strategy at the same time. The end is ugly. Or what's called clustered trading. Information cascades. The transfer of information from those who are the first to act upon it and whose decisions influence others. This actually has a term. It's called whale watching. Whale watching. That's where we watch all the really big names in investing, Warren Buffett, Carl Icahn, and we buy what they buy. They release some forms on the SEC site saying that they now own a position in this or a position in that, and suddenly the stock gets a pop. Why? Because everyone else gets in on it. They follow the leader. They say, well, if that guy's buying, he probably knows something, so I'm just going to go with it. So that's called an information cascade. Results in serial correlations, which means somebody buys it, pushes up the price, makes an announcement that they've been buying, and it suddenly starts, the next day it goes up and up and up, and more people seeing it, see it going up, and just assume that, well, if everyone else is buying it, there must be something in it, right? Serial correlations and perhaps overreactions to information. Overconfidence. This affects everyone, by the way, everyone. Investors have an inflated view of their ability to process information. People are overconfident about almost anything. Take a room of 100 people and say, in this room, I want you to judge your driving ability against everybody else in this room. How many people in this room think that they're better than the average driver in here? 80% of people will raise their hand. That can't be right. Only half the room can be better than the average driver. Ask them about any skill, and 80% of the people will raise their hand. Why? Because everyone else is stupid, not me. So you can walk into a room and you can refer to those stupid people in the market, and everyone will nod going, yeah, those stupid people. Not knowing that maybe they're the stupid people, because no one believes it. You know what? Hey, he's talking about me. I'm the stupid person. Nobody says it. Everybody is overconfident. Everybody. About everything. So just to finish up on behavioral finance, look, there are literally dozens of cognitive biases that have been identified in the literature, emotional biases, behavioral biases. It can go on and on. Some of them are absolutely ridiculous. Some of them are really good. So when you get to level 3, you'll walk through that a little bit deeper. I think what's more important right now is to look at the implications. Okay, let's take behavioral finance at its word that people aren't rational and there are biases that affect their decision making. What does it mean? Well, for the market, it's unclear. It is unclear. And the conclusion is, even if some investors exhibit a bias, as long as enough do not, markets will remain efficient. And there is a lot of literature on equilibrium in systems. Or stasis. And I'll just do a basic economics equilibrium thing here that says that a market or a system can remain in stasis or in equilibrium even if a number of players in that specific industry or a certain amount of the population follow strategies that are not the equilibrium strategy. That the equilibrium position can still persist, even when perturbed by mutations, if you want to get into more of a complexity theory or chaos theory on that one. So even if some investors exhibit bias, the markets can still remain efficient. What does it mean for the investor? Know thyself. I believe that was the inscription above the school at Athens as you walked in. Know thyself. Also, it is a line in Hamlet, Polonius talking to his son Laertes before he takes off to France. He says to him, "This above all, to thine own self be true. If you are subject to certain biases, develop rules to avoid them." So if you know that you're subject to certain biases like loss aversion, I don't like taking losses, well, develop rules to avoid that. If you fall victim to overconfidence, where you're the hero, you're the man, nothing can go wrong, develop rules. Things like position limits, no more than 5 or 10% of your money in any one position. So if you are wrong and you don't like taking losses, the most you can lose is 5 or 10%, never double down. Loss limits. Hey, listen, as soon as I'm down 8% or 9% on a position, I'm done. Just put a rule in. If you have excessive gains or losses in any one particular time, take a time out. Excessive losses, that'll make you gamble more. It'll make you buy lottery tickets. Excessive gains, well, that'll make you take on more risk than you think, and you'll have this idea that, well, I'm that good. You'll get bigger bets and bigger positions, and all you need is for one to go wrong. And trust me, one will go wrong. Take a time out. Take the rest of the day off. Take a couple days off. Even after coming off big gains, I strongly suggest take a couple days off. Take a day or two off. Clear your head. Come back down to earth. Anyways, the next video is going to be how to win the loser's game. I want you to watch it. It's really good. It basically takes this whole reading and puts it into perspective in the marketplace with some real investors, some big names. You're going to recognize most of the names in this video that talk about what it means versus passive investing versus active investing.